In a striking turn of events, the cryptocurrency landscape is witnessing a renaissance as the political climate in the United States shifts dramatically. With the inauguration of President Trump, who has positioned himself as the nation's first crypto president, the regulatory framework surrounding digital assets is undergoing significant transformation. This pivot not only embraces the burgeoning world of cryptocurrencies but also reflects a broader acceptance of blockchain technology across various sectors. The year 2024 marked a resurgence for cryptocurrencies, highlighted by Bitcoin's meteoric rise, surpassing $100,000 for the first time, largely due to its integration into exchange-traded funds ETFs offered by major investment firms. Such developments underscore the maturation of the crypto industry, which is increasingly recognized for its potential to solve complex financial problems and enhance transaction efficiency. According to Raj Dhamodharan, Executive Vice President of Digital Asset and Blockchain Products at Mastercard, the focus for 2025 will be on the intersection of traditional finance and blockchain technology. He emphasized that security, trust, and ease of use must be prioritized for blockchain to reach its full potential. As financial institutions begin to adopt tokenized versions of assets, the implications for the global economy could be profound, leading to reduced transaction costs and enhanced operational efficiency. One of the most notable regulatory shifts is the establishment of a crypto task force by the Securities and Exchange Commission (SEC) shortly after Trump's inauguration. This initiative aims to formulate a cohesive regulatory framework that could provide much-needed clarity for banks and financial institutions looking to engage with digital assets. The recent implementation of the European Union's markets in crypto assets regulation has set a precedent, making it the first major jurisdiction to provide clear guidelines for cryptocurrencies, including stablecoins. Dhamodharan identifies 4 key areas to monitor in the coming year. First, the coexistence of stablecoins and tokenized bank deposits is expected to evolve, with both playing crucial roles in the financial ecosystem. With nearly $200 billion worth of stablecoins in circulation and banks experimenting with tokenized deposits, a more integrated approach to digital transactions is on the horizon. Second, the anticipated regulatory clarity could encourage banks and institutions to experiment with digital assets more freely. The regulatory environment under Trump's administration is expected to facilitate this experimentation, potentially invigorating both innovation and consumer confidence in cryptocurrencies. Third, central banks may pivot away from developing retail central bank digital currencies (CBDCs) for the general public, focusing instead on wholesale CBDCs aimed at financial institutions. This shift could enhance settlement capabilities and facilitate smoother cross-border capital movements. Lastly, the importance of interoperability and trust within the crypto ecosystem cannot be overstated. As the market stabilizes, the necessity for secure and standardized transactional methods will drive the adoption of initiatives such as Mastercard's multi-token network, which aims to enhance the scalability and security of digital asset transactions. As the cryptocurrency sector expands, new investors are entering the market, drawn by the allure of high returns. However, experts caution that the volatility inherent in cryptocurrencies poses significant risks. According to a recent report, Americans lost a staggering $5.6 billion to crypto scams in 2023, highlighting the need for vigilance and education among new investors. Beginners are advised to determine whether they want to invest for the long term or engage in active trading. Only invest what they can afford to lose. And be mindful of hidden fees on exchanges. The current atmosphere around cryptocurrencies signals a pivotal moment in their evolution. With a combination of regulatory support, technological advancements, and growing mainstream acceptance, the future of digital assets appears bright. As we move through 2025, it will be crucial to observe how these developments unfold and how they will redefine the financial landscape, potentially integrating digital assets deeper into everyday commerce and investment strategies. In an era where Bitcoin continues to capture the imagination of investors and tech enthusiasts alike, BitFuFu Inc. has released its latest operational updates, revealing significant developments in its mining activities for January 2025. As a notable player in the Bitcoin mining industry, BitFuFu's announcements are keenly observed by stakeholders looking to gauge the health and direction of the cryptocurrency market. According to the latest report, BitFuFu produced 83 Bitcoins through its self-mining operations while generating an additional 200 Bitcoins for its cloud mining customers. As of January 31, 2025, the company holds a total of 1742 BTC, a figure that includes 633 BTC pledged for loans and other obligations. This production reflects a 25% decrease from December 2024, attributed primarily to the expiration of a hashrate purchase order and a strategic reallocation of resources toward fulfilling cloud mining contracts. The company is also making strides in expanding its mining capacity. In March 2025, BitFuFu expects to energize 2,000 units of S21XP miners, which will enhance its mining capacity by an additional 0.54 EH/s. Furthermore, BitFuFu has signed a letter of intent to acquire a 51-megawatt Bitcoin mining facility in Oklahoma, where it anticipates favorable operating conditions with an average power cost of just 3 cents per kilowatt-hour. We actively manage and rebalance our mining capacity and operations to ensure stable cash flow, minimize risk, and support our strategic expansion plans, said Leo Liu, chairman and CEO of BitFuFu. The company currently manages an impressive total hash rate of 20.2 EH/s with significant contributions from both self-owned and cloud mining operations. BitFuFu's commitment to maintaining competitive electricity costs is underscored by its diverse portfolio of power sources, including hydropower in Ethiopia and grid power in the US, which collectively provide a robust foundation for its mining endeavors. As the landscape for Bitcoin mining evolves, so too does the demand for cloud mining services, with BitFuFu's registered user base reaching nearly 600,000. The launch of BitFuFu OS, a new software service designed to optimize mining operations and enhance profitability, further positions the company to capitalize on this growing sector. Beyond these operational highlights, BitFuFu is set to participate in several upcoming conferences, including the Alliance Global Partners Virtual Technology Conference and the 37th Annual Roth Conference in March 2025, where key executives will engage with investors to discuss future strategies and opportunities. In a broader context, the cryptocurrency market remains buoyant, with many analysts speculating on the potential for Bitcoin's price trajectory. Prominent figures within the industry, such as Daniel Roberts, CEO of IREN, have forecasted that Bitcoin could reach an astonishing $1 million by 2030, fueled by increased institutional adoption and the cryptocurrency's intrinsic value as a digital store of wealth. However, challenges remain, particularly as rising mining difficulty and operational costs threaten to squeeze margins for mining companies. As BitFuFu continues to navigate the complexities of the Bitcoin mining industry, its strategic expansions and innovative services may not only enhance its competitiveness but also contribute to the overall growth and stability of the cryptocurrency space. Looking ahead, the interplay between technological advancements, market demand, and regulatory developments will be critical in shaping the future of Bitcoin and its mining ecosystem. The coming months will likely prove pivotal as BitFuFu and its peers adapt to this ever-evolving landscape. In a striking development within the cryptocurrency landscape, the political arena has embraced digital currencies led by the controversial figure of Donald Trump. The launch of the official Trump meme coin $Trump has not only stirred interest among investors but has also sparked a wave of meme coins, including the newly introduced Melania coin $Melania. This trend signifies a remarkable intersection of politics and cryptocurrency, where digital assets are increasingly seen as tools for fundraising and community building. The Trump coin, which surged to an impressive market capitalization of nearly $75 billion shortly after its launch, has recently witnessed significant fluctuations. As of February 6, 2025, the coin experienced a noteworthy 4.27% increase in value, reaching $18.50. Although it remains down by over 75% from its January highs. This volatility can be attributed to a combination of broader market trends and specific political actions, including President Trump's recent tariff announcements, which have adversely affected the cryptocurrency market. Despite these challenges, the Trump coin has managed to maintain its status as one of the top meme coins, although it has dropped in market cap rankings from 14th to 32nd as indicated by CoinMarketCap. The meme coin phenomenon is not limited to the Trump coin. Melania Trump has also entered the fray with her own digital asset $Melania, which she announced on social media. This coin aims to capitalize on the popularity of meme-based cryptocurrencies and demonstrates the growing trend of public figures leveraging blockchain technology for personal branding and fundraising efforts. The launch of the Melania coin is indicative of a broader acceptance of digital currencies in political campaigns. With Trump himself having shifted from previously labeling cryptocurrencies as scams to actively promoting their use within his campaign. The implications of this political embrace of cryptocurrencies are profound. As Trump's administration prepares to take office, the cryptocurrency industry is gearing up for a significant influence on policy, with insiders suggesting that they are preparing a wishlist for the president-elect's first term. The recent Crypto Ball event hosted by David Sachs, Trump's appointed cryptocurrency czar, further underscores this alignment of political and economic interests as industry leaders and advocates gather to discuss the future of cryptocurrency regulation and innovation. However, the rise of meme coins, particularly the Trump coin, has raised concerns regarding market manipulation and stability, given the heavy involvement of insiders linked to its creation. The question of long-term viability looms large as investors grapple with the coin's erratic performance and the potential for future regulatory scrutiny. Interestingly, the emergence of competitors such as Ozak AI and its OZ token signals a shift towards more utility-driven cryptocurrencies focusing on real-world applications rather than mere speculative trading. Ozak AI aims to use artificial intelligence to provide predictive analytics for investors, offering a stark contrast to the meme coin market that thrives on volatility and social media hype. This focus on technological integration and practical applications may attract a different segment of investors seeking stability and strategic tools in their cryptocurrency endeavors. As the cryptocurrency market continues to evolve, it remains to be seen how these developments will shape the regulatory landscape and investor sentiment. The intersection of politics and digital assets could pave the way for new innovations, but it also poses challenges that require careful navigation. With the political climate increasingly intertwined with the world of cryptocurrency, the next chapter in this unfolding narrative will be one to watch closely as it unfolds in the coming months. In the fast-paced world of cryptocurrencies, volatility often reigns supreme, and Ethereum is currently at the heart of a significant market shift. As of early February 2025, Ethereum's value has plummeted approximately 17% year-to-date, including a staggering 20% drop in a single day, raising concerns among investors about the future of the second-largest cryptocurrency by market capitalization. However, industry analysts suggest that this downturn may present a valuable buying opportunity for those who believe in Ethereum's long-term potential. Despite the recent dip, Ethereum remains a dominant force in the blockchain landscape. It commands a substantial 54% market share in the decentralized finance DeFi sector and accounts for 10% of the total cryptocurrency market cap, valued at about $331 billion. This resilience is bolstered by the anticipated launch of a significant technological upgrade in March known as Spectra, which aims to improve transaction speed and cost efficiency, key factors that can enhance user experience and attract new developers. The recent decline in Ethereum's price has been exacerbated by increasing competition from newer blockchains such as Solana, which offer faster and cheaper transactions. This competition has prompted some investors to reassess their positions, with many expressing concern over Ethereum's ability to maintain its market leadership. Nevertheless, Ethereum's co-founder Vitalik Buterin has called for a renewed focus on Layer 2 scaling solutions, which are essential for improving the network's performance and retaining user engagement. Moreover, Ethereum's prospects have received a boost from political support.
The administration of President Donald Trump appears to be positioning the cryptocurrency favorably within its broader economic agenda, particularly in the realm of DeFi.
This endorsement is exemplified by recent investments from Trump-affiliated entities, further legitimizing Ethereum's role in the future of blockchain technology. Adding to the intrigue surrounding Ethereum's market dynamics, Eric Trump recently sparked a rally in Ethereum prices with a well-timed tweet encouraging investors to buy the cryptocurrency. Following his endorsement, Ethereum rebounded sharply from a low of around $2,300 to over $2,900 within a day. While this spike demonstrates the potential for rapid price recovery, it remains to be seen whether a similar rally can be expected for Bitcoin, which is currently trading near all-time highs and operates under different market conditions. As investors weigh their options, the question of whether to buy the dip in Ethereum becomes increasingly relevant. Historically, purchasing during downturns has proven beneficial, and with some analysts predicting a return to Ethereum's all-time high of $4,891, there appears to be significant upside potential for those willing to invest at this juncture. In conclusion, while Ethereum's recent decline may have caused alarm among investors, the underlying fundamentals and upcoming technological advancements suggest that the cryptocurrency still holds strong potential for growth as the market continues to evolve. Ethereum's ability to adapt and innovate will be crucial in determining its future trajectory. Investors would do well to keep a close eye on both the technological developments and market sentiment as 2025 unfolds, as these factors will play a pivotal role in shaping the landscape of digital currencies. Ethereum, once the crown jewel of the cryptocurrency landscape, is now facing formidable competition, particularly from the rapidly growing Solana blockchain. Analysts at JP Morgan have recently highlighted the challenges Ethereum is encountering in maintaining its market share, suggesting that the second-largest cryptocurrency is struggling to keep pace with both Bitcoin and its alternative counterparts. According to a report by JP Morgan's managing director Nikolaos Panagurtsoglou, Ethereum has underperformed significantly in comparison to Bitcoin and other altcoins since the recent US elections. The report indicates that Ethereum's price has dipped below the $3,000 mark, plummeting as low as $2,200, raising concerns among investors about its long-term viability. This decline is attributed to two primary factors: the rise of more scalable and cost-effective blockchains like Solana, and a lack of a compelling narrative that could position Ethereum as a store of value akin to Bitcoin. Despite Ethereum's recent Denkin upgrade, which was intended to enhance its performance, there has been a notable shift in activity towards Layer 2 networks and application-specific chains. This trend poses risks to Ethereum's fee revenue and raises concerns about the potential for inflation within the network due to reduced token burn. While Ethereum retains its leadership in sectors such as stablecoins, decentralized finance, DeFi, and tokenization, the JP Morgan team expressed skepticism about its ability to sustain this dominance amidst the growing competition. As Ethereum grapples with these challenges, Solana's ascent has been particularly noteworthy. The blockchain, known for its high throughput and low transaction fees, is increasingly attracting developers and decentralized applications that were once dedicated to the Ethereum ecosystem. This exodus not only threatens Ethereum's revenue model but also its status as the go-to platform for innovative blockchain solutions. The implications of this competition are significant. Analysts warn that the ongoing migration of decentralized applications to alternative blockchains could lead to a substantial loss in Ethereum's user base and market dominance. Furthermore, institutional investors who have shown interest in Ethereum may reassess their strategies if the platform cannot demonstrate a competitive edge over Solana and other emerging blockchains. In light of these developments, the cryptocurrency market is witnessing a shift in attention. As Solana's price remains relatively stable amidst Ethereum's volatility, it is clear that many investors are beginning to view Solana as a viable alternative. The market dynamics are shifting, with whales, large investors, quietly accumulating various altcoins including Solana and XRP, which suggests that they anticipate significant developments in the near future.
As Ethereum continues to navigate these turbulent waters, the question remains: can it adapt and reclaim its former glory in a landscape increasingly dominated by agile competitors?
The answer may hinge on its ability to innovate and present a compelling narrative that resonates with investors and developers alike. With the cryptocurrency sector evolving at a breakneck pace, the coming months will be crucial for Ethereum as it seeks to redefine its place within this competitive environment.